Warren Buffett, the legendary investor known as the Oracle of Omaha, has a surprising take on real estate investments. Despite his vast experience in various investment fields, Buffett considers real estate a potentially lousy investment, especially for certain types of investors. But why would one of the world's most successful investors hold such a view on what many consider a cornerstone of wealth building? Do watch till the end, so you truly understand Warren Buffett's thoughts on real estate as an investment. Before we dive in, I want to remind you to hit that like button and subscribe if you haven't already. It really helps my channel grow, and I appreciate your support. Without further ado, let's get started. The experience factor. Buffett and Munger's real estate background. Warren Buffett and his longtime business partner Charlie Munger are no strangers to real estate. In fact, Munger made his early fortune in real estate. This begs the question, if real estate was lucrative for them in the past, why the current skepticism? Their experience provides a unique lens through which they view the real estate market, offering insights that might challenge conventional wisdom. How does their historical success in real estate inform their current stance? Real estate, not quite a commodity. One of Buffett's key points is that real estate is not a commodity, but it tends to be more accurately priced than many people realize. This is especially true for well-developed real estate. What does this mean for potential investors? It suggests that finding significantly undervalued properties might be more challenging than many assume. How does this accuracy in pricing impact the potential for outsized returns in real estate investments? The RTC era, a rare opportunity. Buffett recalls the Resolution Trust Corporation, RTC period, as a time of significant mispricing in real estate. During this era, there were huge amounts of transactions, and many properties were owned by entities that didn't want to be owners and often didn't fully understand what they owned. This created a perfect storm for savvy investors to capitalize on mispriced assets. But how often do such opportunities arise in the real estate market? And what would it take for a similar situation to occur in today's market? The challenge of finding mispriced real estate. Under normal market conditions, Buffett argues that it's hard to find real estate that's truly mispriced. He points to the transactions that real estate investment trusts, REITs, engage in, noting that they're often very similar and based on a competitive understanding of property values. This raises an important question. In a world where information is readily available and professional investors scrutinize every deal, how can individual investors hope to find truly undervalued properties? The conventional wisdom conundrum. Buffett suggests that it's difficult to argue with the current conventional wisdom in the real estate world most of the time. While this doesn't mean that conventional wisdom is always correct, it does imply that going against the grain in real estate investing can be risky. How can investors balance the need to find unique opportunities with the wisdom of the crowd? Is there still room for contrarian thinking in real estate investing? Chaos and opportunity when real estate becomes interesting. Despite his general skepticism, Buffett acknowledges that big opportunities in real estate can exist, particularly when there's chaos in real estate financing. This suggests that market disruptions can create openings for astute investors. But how can one identify these moments of chaos? And more importantly, how can an investor position themselves to capitalize on these rare opportunities when they arise? The competitive disadvantage. Experience matters. One of the most striking admissions from Buffett is that he and Munger don't have any competitive advantage over experienced real estate investors. This humility from two of the world's most successful investors is telling. It raises the question, if Buffett and Munger don't feel they have an edge in real estate, should average investors be wary of thinking they can outsmart the market? How crucial is specialized knowledge and experience in successful real estate investing? The tax structure dilemma. C corporations and real estate. A significant factor in Buffett's reasoning is the tax structure of Berkshire Hathaway as a C corporation. This structure creates a whole layer of corporate taxes between the real estate income and the use of that income by the property owners. Buffett argues that this makes real estate a very lousy investment for entities taxed under Subchapter C of the Internal Revenue Code. How does this tax consideration change the calculus for different types of investors? Are there structures that can mitigate this tax disadvantage for corporate investors? The time factor, where Buffett chooses to focus. Given their lack of special competence in real estate and the tax disadvantages for their corporate structure, Buffett and Munger spend almost no time thinking about anything in real estate. This strategic decision to allocate their attention elsewhere is crucial. It prompts us to consider, how important is it for investors to recognize their areas of competence and stick to them? In a world of endless investment opportunities, how should one decide where to focus their time and resources? Berkshire's real estate record, a self-critical view. Interestingly, Buffett candidly admits that Berkshire Hathaway has a poor record in handling the real estate they do own, such as surplus real estate they've tried to sell off. This admission highlights the importance of self-awareness in investing. How can investors honestly assess their own performance and learn from their mistakes in real estate or any other investment area? Structural disadvantage of C corporations in real estate. Buffett emphasizes that C corporations are at a structural disadvantage when competing with other entities like S corporations, REITs, partnerships, or individuals in real estate investments. This disadvantage is due to the additional layer of taxation. How does this structural issue shape the real estate investment landscape? Does it create opportunities for certain types of investors at the expense of others? Missed opportunities, the RTC days revisited. Despite their general wariness of real estate investments, Buffett acknowledges that they missed the boat to some extent during the RTC days. This period of market inefficiency and lacks of financing could have been highly profitable for Berkshire had they been better prepared. What lessons can be drawn from this missed opportunity? How can investors prepare themselves to act decisively when rare market dislocations occur? The Irvine Corporation, a big real estate opportunity considered. Buffett mentions that they seriously considered buying the Irvine Corporation when it became available around 1977. This shows that despite their general skepticism, they were open to large-scale real estate investments under the right circumstances. What factors might make a real estate investment attractive enough for even skeptical investors like Buffett to consider? How can investors identify similar opportunities in today's market? The rarity of attractive opportunities. Buffett concludes by noting that while opportunities like the Irvine Corporation could conceivably happen again, they are rare. This underscores the challenge of finding truly attractive real estate investments, especially for investors operating under certain constraints. How should this rarity factor into an investor's overall strategy? Is it worth waiting for these rare opportunities? Or is a more active approach to real estate investing necessary? Warren Buffett's perspective on real estate as a potentially lousy investment challenges us to think critically about this popular asset class. His views are shaped by a combination of factors: the general accuracy of real estate pricing, the tax disadvantages for certain corporate structures, and the rarity of truly mispriced opportunities. However, Buffett's stance is nuanced, acknowledging that there can be exceptional circumstances where real estate becomes an attractive investment. In the ever-evolving world of investments, Warren Buffett's cautious approach to real estate serves as a reminder that critical thinking, self-awareness, and a willingness to go against conventional wisdom when the numbers make sense are key to long-term success. What's your preferred type of investment? Comment below. You may also wish to check out my other video on 10 buy and hold forever dividend stocks for passive income in the link above and in the description down below. If you enjoyed this video, do like and share this video so that more people will learn about whether real estate is a lousy investment. Check out this playlist of my top 10 videos for creating wealth, and I'll see you in the next video. Take care.